So again, let's try to trace the entries in the work paper for the adjustments and eliminations. Okay, now the entry for number 1, that's an elimination entry, debiting to S company, eliminating S company retained earnings. So that's number 1 for a debit of 120,000. That's for S company. Then we debit common stock at par of S company for 240,000. So the total is 360,000. Now, what are the corresponding credits here? We have to credit investment in S company for the amount of 288,000. Now that's for the investment account, and we now have another debit for 84,000. Now take note that we are eliminating the common stock of S. Now S company retained earnings and common stock. So the retained earnings of S company 420,000, and the common stock of S company for 240,000. So that makes a total of 360,000. Now that's for the debit. But in our credits, we have now investment in S company for the amount of the investment in subsidiary, since X company or S company, there are adjustments to the overvaluation and undervaluation of the account. So we now have the entries as explained here. We have the amounts of uh, investments. So we have here the consolidation work paper, where we are now recording the investment account, and likewise the corresponding retained earnings account. Now before we go back to the work paper, now let's look at the entries for consolidation in the year 20x4. In the year 20x4, before we proceed to the work paper. Now, actually, the work paper is requirement of number 6. That's the worksheet. But of course, before we go to that worksheet entries, we have the requirement in number 5 for the working paper, eliminating the 20x4 and 20x5 reciprocal accounts. So first, we go to requirement number 5 for the consolidation work paper. Using the partial goodwill, we now debit to common stock of S, debit to retained earnings of S, and then we credit to investment in S company for 288,000, and we have the non-controlling interest in the amount of 72,000 to eliminate intercompany investment in equity accounts of subsidiary on date of acquisition, and to establish non-controlling interest in the net assets of the subsidiary. So we have now your NCI credited for 272,000, and we credit the investment for 288,000. Now, likewise, we have the adjustments to recognize the undervaluation or the overvaluation of the assets and liabilities of the subsidiary. We are now debiting inventory for 6,000, debiting accumulated depreciation of the equipment by 96,000 because of the undervaluation by 96,000, to debit accumulated depreciation to buildings, debit to land, debit to discount on bonds payable, and debit to goodwill for 12,000. Now, likewise, we credit to buildings for 216,000 and non-controlling interest at the rate of 18,000. We are crediting non-controlling interest for another 18,000 and credit investment in S company for the amount of 84,000. Now that's a credit. So we are now adding 288,000, the credit investment in E1, and we have the credit investment in E2. That's now a total of 372,000. Now take note, in E1 we have a credit investment 288,000, and in E2 we have a credit in the amount of 84,000. Then the non-controlling interest in E1, the non-controlling interest is credited for 72, and in E2 we are crediting it for 18,000. So all in all, the total is 90,000, while the credit investment is 288,000 and 84,000. So to allocate excess of cost over book value of identifiable assets acquired with remainder to goodwill and to establish non-controlling interest in net assets of subsidiary. Then the third entry is to debit cost of goods sold in relation to the undervaluation of inventory. We debit depreciation, debit to accumulated depreciation of buildings because of the overvaluation of buildings, debit to interest expense for discount on bonds payable, debit to goodwill impairment loss for 3,000, credit to inventory 6,000, credit to accumulated depreciation of equipment for 12,000, and credit discount on bonds payable 1,200, and credit to goodwill for 3,000. Now, to provide for 20x4 impairment loss and depreciation and amortization on differences between acquisition date fair value and book value of Sun's identifiable assets and liabilities. So we have now the inventory is considered as sold, 6,000, and the equipment, the depreciation annually, that's 96,000 divided by remaining life of 8 years. So we have now 12,000. And the buildings, due to the overvaluation, we are deducting by 6,000. And interest expense is to be recorded for the discount amortization, 1,200. It should be observed that the goodwill computed above was proportional to the controlling interest of 80% and the non-controlling interest of 20% computed as follows. The goodwill applicable to parent, 80% of the goodwill is 12,000, and 20% goes to the non-controlling interest. Therefore, the goodwill impairment loss of 3,125 based on 100% fair value. Actually, the goodwill impairment loss is 3,750. 3,750. That's the goodwill impairment loss, not 3,125. Based on 100% fair value or goodwill would be allocated as follows. So 3,750 times 80% or 3,000, and 3,750 times 20% is 750. So we have now E4. Take note that in E3, we have this entry. Again, the entry in E3, debit cost of goods sold, debit depreciation expense, debit accumulated depreciation of buildings. Then we have to debit interest expense. We debit goodwill impairment loss, the credit to inventory, credit accumulated depreciation of equipment. That's already good for 2 years. And we now credit discount on bonds payable in the amount of 1,200 credit to goodwill. Then, in entry number 4, debit to dividend income. S company now, the subsidiary company is giving dividends of 36,000. 20% of it will go to the non-controlling interest. So debit to dividend income, 28,800. That's for the parent. Debit non-controlling interest, 7,200. And credit dividends paid by S company. Then E5, we have now the non-controlling interest in net income of subsidiary. The net income of subsidiary is computed at 60,000. That's the net income of the subsidiary. So we have now 60,000 deduct the allocation of amortization of allocated excess. Amortization of allocated excess. In E3, we have the amortization of allocated excess. In E3, in the amount of here, in E3, the allocated excess, the amount of allocated excess in E3 in the amount of 13,200 as computed in this table, 13,200, and we have to deduct that from the net income of the subsidiary. Then we multiply by the non-controlling interest equal to 20%. We have the non-controlling interest net income of the subsidiary in the amount of 9,360. So we now debit to non-controlling interest in net income, credit non-controlling interest in the amount of 9,360. While in E4, we debit to non-controlling interest for 7,200. And finally, we have the worksheet. Now to explain the differences in the amounts, we have dividend income of P company, sales of P company amounting to 480,000, dividend income of 28,800 now eliminated in E4, debit to dividend income of 28,800, debit to non-controlling interest, and credit dividends paid by S. Dividends paid by S, that's why P company has dividend income of 28,800 that was paid by S company. Then we have depreciation, likewise reflecting the adjustments to the depreciation and cost of goods sold accounts in the previous entries. So take note, we have entries in number 3 and in number 5 for the non-controlling interest. So we have now the net income to be close to retained earnings of 202,440. That's the amount that we close to the retained earnings of the parent. So we have retained earnings beginning of P company for 360,000, then S company of 120,000. But we have to eliminate in elimination entry number 1 and net income from above as computed in previous table 202,440, and we have now the total and the dividends paid to be deducted. Dividends paid of 72,000 paid by the parent, and the dividends paid by S company now eliminated. And finally, for the balance sheet figures, we have this copied from the given accounts of P company and the S company. The only thing is we have the numbers representing the adjustments in the previous entries, and so as to arrive at the adjusted amounts. So we have now the likewise the equipment account in requirement previous requirement of 420,000. We deduct the accumulated depreciation of 147,000. So that is with regards to equipment of 420,000 minus 147,000. That's why in the requirement in number 2, you have the net amount of 273,000. Now the buildings of 1,044,000 minus the accumulated depreciation of 495, we have the net book value of 549,000 as we will go back to the previous requirements. So the non-controlling interest, initially, take note that we have the numbering in the entries. See to it that the debits will tally with the credits. So we have now your requirement number 6, and that is with our related to the requirement that we have in number 2 above. Okay, class, you may already exit if you want to. However, just refer to the YouTube for the rest of my discussions. I am going to finish problem 1 today so that by tomorrow we are going to continue with problem 2. So you may exit already. Any questions? Okay. I-end na lang.